Hello, and welcome to Credit Compass, your guide to navigating European credit markets. This week we start with Asia and ask what lessons Europe can draw from the disruption around the Strait of Hormuz. We then turn to the March industrial production data across Europe, where the picture is becoming more differentiated. Southern Europe and parts of France are showing signs of improvement, while Germany remains under pressure. Finally, with nearly half of the STOXX Europe 600 companies having reported first quarter results, we look at what earnings season is telling us about margins, demand, and investor sentiment. The broad theme this week is divergence. Divergence between Asia and Europe, divergence within European industry, and divergence among investors over whether the current market momentum still has room to run. All right, let's dig in. Let's begin with the Strait of Hormuz and the question investors are increasingly asking: is India the canary in the coal mine? On Sunday, Prime Minister Narendra Modi urged Indians to conserve fuel, use public transport, and work from home where possible. The government has also encouraged households to shift cooking fuels where feasible, avoid hoarding, cut non-essential gold purchases, and restrict overseas travel. The goal is straightforward: conserve energy, protect foreign exchange reserves, limit the current account deficit, and support the rupee. But why does this matter for Europe? Well, because Asian economies are among the most exposed to energy flows through the Strait of Hormuz. If the disruption continues, Asia is likely to feel the squeeze first. That makes the region a useful early warning system for the rest of the world. Europe is not in the same position as India, but the channel of transmission is familiar. Higher energy prices, weaker trade balances, pressure on industrial margins, and a more complicated inflation picture. Over time, there will be substitution, production from other sources will increase, supply chains will adapt, but adjustment takes time, and tight energy markets can create financial stress before physical shortages become severe. So the Asian example is not a perfect map for Europe, but it is a warning sign. If the disruption persists, the next phase may not just be about oil prices, it may be about confidence, currency pressure, industrial competitiveness, and the ability of policymakers to shield households and companies without furthering inflation risk. Now, let's bring the discussion back to Europe and look at what the latest industrial production data is telling us. This past week, March industrial production releases came through across the continent. Given the pressure from energy prices and the uncertainty around global trade, the data offered a few bright spots, but also some clear signs of strain. Spain had one of the strongest releases among the large euro area economies. Its industrial production index rose 2.3% month on month, while the annual rate was plus 1.8% after seasonal and calendar adjustment. The improvement was broad-based across consumer goods, capital goods, and intermediate goods. Energy, however, remained negative. France also improved meaningfully. Whole industrial output rose 1% month on month in March, while manufacturing increased 1.2%. Over the first quarter, output was 0.9% higher year over year in whole industry and 1.5% higher in manufacturing. For an economy that has struggled to generate industrial momentum, that is a constructive signal. Germany, however, remains the clear laggard. The Strategist reported that industrial production fell 0.7% month on month in March and was 2.8% lower than a year earlier. The 3-month comparison was also weak. Production in January through March was 1.2% lower than the previous 3 months. Germany is still the euro area's industrial anchor. Chancellor Friedrich Merz is trying to improve the country's industrial performance, but the turnaround is not yet visible in the production data. There was, however, one encouraging sign. Manufacturing orders were much stronger, rising 6.3% year over year in March, up from 3.5% growth in February. Now, orders are not output, but they are an important leading indicator. Ireland is the main downside outlier, though it needs a little bit of careful handling. Irish industrial data can be heavily distorted by multinational activity, outsourced production, and the structure of its modern sector. Still, the decline was notable. Chemicals, pharmaceuticals, computers, and electronics fell 15.4% year on year on a 3-month basis. The sector-level message is also mixed. Capital goods are improving selectively, but they are not booming. I would describe the European capital goods cycle as selectively improving rather than broadly strong. Transport equipment is one of the brighter spots. France and Italy both showed strong transport equipment growth. Germany's auto production also rose, which helped offset the weakness elsewhere. Energy remains a drag in several countries. That matters because energy volatility does not stay confined to the energy sector. It feeds into margins, working capital needs, pricing decisions, and eventually credit quality. Chemicals and other energy-intensive industries remain fragile. This is still one of the structural pressure points for European industry: high energy sensitivity, global competition, and limited pricing power. The bigger takeaway is that Southern Europe currently looks better than core Europe. Spain, Portugal, and Italy all improved in March, while Germany contracted. The old assumption that Germany leads the industrial cycle is not working especially well in this data. Now, let's turn to earnings. With nearly half the STOXX Europe 600 having reported its first quarter results, a few themes are starting to come through. Broadly, the first quarter reporting has been positive on earnings, weak on revenues, and selectively constructive on forward guidance. At the index level, this is a decent earnings season. LSEG estimated first quarter earnings growth at 10% year over year, or 6% excluding energy. Through the 7th of May, 211 companies had reported earnings. Of those, 60% beat analyst estimates, above the long-run average of 54%. Aggregate earnings were 9% above estimates, also stronger than the long-run average surprise factor, but the sales line is less impressive. Q1 revenue growth was estimated at only 0.2% year over year, and reported revenues were running 1% below estimates. Only 53% of companies beat revenue forecasts, below the long-run average of 58%. That tells us something important. Companies are still defending margins, but top-line demand is not especially strong. This is an earnings beat, not a broad-based demand boom. Europe is showing operational resilience, helped by energy and financials, but the revenue picture stays nominal. Growth remains thin outside of a handful of sectors. The cleanest index-level proxy is estimate revisions. LSEG shows that the weekly revisions balance turned positive by the week ending 7th of May, with 57% upward revisions and 43% downward revisions for STOXX 600 fiscal year 1 estimates. That is a meaningful improvement from mid-April, when downward revisions outnumbered upward revisions. The caution is that the implied growth path still looks quite positive for the year. In other words, forward estimates continue to embed a fairly strong second half and fourth quarter acceleration. That leaves investors with a difficult question. Are analysts correctly identifying a coming earnings acceleration, or are markets assuming too smooth a path through a volatile macro environment? So, where does that leave us with regards to markets? Well, investor views are becoming more divided. On one side, a growing group argues that markets may be entering something that resembles the late 1990s technology cycle. The thesis is that artificial intelligence could trigger a major productivity boom, supporting higher capex, higher earnings, and potentially higher valuations. On the other side, equally influential voices are warning that markets may be too complacent. Their concern is not simply valuation, it is the combination of tight spreads, geopolitical risk, energy volatility, and the possibility that inflation proves harder to control if supply chains remain disrupted. That debate was visible in recent investor commentary. Apollo's latest public comments were particularly interesting for Europe. Apollo framed Europe as both a retirement services growth market and a large future market for investment-grade private credit. The key proof point was Athora's closing of the Pension Insurance Corporation transaction, which doubled Athora's assets to roughly $125 billion and added a major UK organic growth market. Mark Rowan also emphasized that PIC creates demand for pound-denominated assets suitable for UK regulated balance sheets. The comparison is a theme in the US, which sources dollar-denominated investment-grade assets for US regulated insurance balance sheet. Apollo also linked Europe to the broader theme of a global industrial renaissance. Rowan pointed to infrastructure, energy transmission, the energy transition, advanced manufacturing, defense, AI, and data infrastructure as areas where Europe may need substantial private capital. The argument is that Europe could become one of the strongest percentage growth markets for investment-grade private credit. It has many of the same capex needs as the US, but with less developed capital markets and more constrained bank financing capacity. At the same time, Apollo's tone was not simply bullish. The firm's defensive positioning and move up in quality reflect a view that the macro backdrop is fundamentally strong, but carries a higher than normal risk of unexpected outcomes. Rowan pointed to healthy employment, a strong capex cycle, accommodative government policy, and open capital markets, but he also flagged the geopolitical reset, potential inflationary pressure from restrictions on goods and labor, the disruptive impact of the AI and technology cycle, and weaker government balance sheets. So, Apollo is not pulling back from investing, but it is emphasizing capital protection and the ability to ride through corrections. In credit, that means moving upmarket, more investment grade, more structure, more collateral protection, and less exposure to areas such as software or highly levered lending. The point is not simply to reduce risk, it is to capture spread in higher quality private credit where the risk-adjusted return still looks attractive. Now, the annual Milken Conference produced a similar message. The European view there was that private credit is becoming a broader financing solution, not just a risk story. With bank lending still dominant, capital needs raising, and policy priorities such as infrastructure, defense, AI, and the energy transition all require funding. Europe was seen as a market with room to expand and strong demand for non-bank capital. Panelists and related commentary also suggested that recent concerns around private credit may be overstated and could create opportunity, especially if spreads improve and M&A activity picks up. Then there was Berkshire Hathaway. The latest Berkshire annual meeting was less a celebration of a stock and more a lesson in capital discipline at the top of the cycle. Greg Abel's first meeting as CEO emphasized continuity, decentralized management, no breakup plan, patience, and a willingness to act decisively only when price and risk line up. It also reinforced Warren Buffett's warning that markets remain unusually speculative, while Abel's patient but decisive framing helped explain Berkshire's large cash position. For European credit investors, the translation is relatively straightforward. Own liquidity, own quality, and be patient and prepared. The signal is not that investors should hide in cash forever. It is that patience has value, especially when front-end rates still provide compensation. So, to bring it all together, this week's credit message is about resilience, but also selectivity. Energy disruption is starting to create visible behavioral and policy responses in Asia, which Europe should watch closely. European industrial production is stabilizing in places, especially southern Europe and parts of France, but Germany remains a materially weak spot and still struggles to emerge from its slump. Corporate earnings are beating expectations, but revenues are soft, which means margin discipline is doing more of the work than demand growth. And investors are starting to split into two camps. One sees AI, capex, and private credit as the foundation for the next expansion. The other sees tight spreads, geopolitical risk, and speculative behavior as reasons to move up in quality. Both can be true at the same time. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.